Hi, my name is Christina and welcome to my channel. Today I'm going to talk to you about how to start investing. By the end of this video, you should be able to know how to start investing, some real-world working knowledge of how all these investments work, how to open up a brokerage account, and how to mitigate risk. The reason why I'm making this video is because after going to college, after working 2 jobs in investment banks, one at Goldman Sachs and Bank of America, I never knew a thing about personal finance. That's why I've spent the last 2 years gathering all the information I can to tell you the basics of investing, because right now we're in a recession, inflation's at its highest, so this is the best time to start investing. So tune in to the next 5 to 10 minutes so you can start being the rich man that your mom always wanted you to marry. First, I'm going to talk to you about why you need to start investing right now. 2, I'm going to talk about the 5 questions you need to ask yourself before you start investing. 3, I'll talk about how to allocate your portfolio. 4, I'll talk step by step about how to actually open a brokerage account and move money into there so you can start investing. And then lastly, we'll go over some brief vocabulary. So the main reason we want to start investing is because your money is losing value over time due to something called inflation. Inflation is when the price of goods and services go down, so the buying power that you had before is actually worth less now than what it was before. For example, let's say you had $100 last year. However, inflation is 9.1%. Therefore, your money is only worth $91.90. So you kind of lost $10. However, if you were to have put that $100 into an investment account or a stable investment, you would actually have either 1, made more money, or 2, preserve the capital. Before you start investing, I always tell people to ask themselves 5 questions. 1, do you have an emergency fund? An emergency fund is super important because you never know what's going to happen in the market. You never know if there's something that happens to your family, to yourself, and you need to have cash on demand. So I always tell people to have around 3 to 6 months cash savings. I personally have 3 months cash savings because I don't have kids, I don't have a mortgage, I don't have any high yield debt. So I'm kind of fine in that sense. 2, have you paid off high yield debt? This doesn't include student loans because that's actually kind of good debt to have, and I'll talk about that a little bit later. However, you want to pay off all your high yield debt. That includes your credit cards, anything that's an insane amount of APR, because you're actually losing money if you invest instead of paying off that debt. 3rd, are you a long-term or short-term investor? If you're more risk-averse like myself, it's really good to be a long-term investor because all you have to do is just set it and forget it. And over time, compounding interest will make money for you. Basically, long-term investors are holding a stock for more than 1 year. Short-term investors are your day traders, your option traders. Essentially, it's super risky and you have to pay more taxes. 4, how risk-averse are you? Again, I consider myself a long-term investor, so I like to set it and forget it, and over time, your returns will on average be above 10% or at 10%. However, those who handle more risk are able to trade options, trade futures, day trade. Now, I've done this before, but I don't recommend it to anyone. I know some people who are pretty successful, but they also are not afraid to lose the money that they're putting in there. And the last rule, which is the most important, but is the least likely to happen if you know how to invest correctly, is are you willing to lose everything that you've invested? Now, like I said, this probably won't happen if you're allocating your portfolio correctly, but if you YOLO into a meme stock or APIN into a crap coin, then you're probably losing a lot of your money. So just be careful about what you're investing in, and I'll talk about portfolio management in the next section. Portfolio construction is super important when you start investing because you need to make sure that you're diversifying your assets and not putting all your money into one basket. So I like to use the 100 rule, and this is something that I've learned. So it's basically taking 100 minus your age, and that percentage is what you would put into stocks, and then your age as a percentage would be into bonds. So I'm 26 years old. If I had $1,000, I'd essentially take $260 and put that into stable investments like a bond, and then I would take $740 and put that into stocks. Now, I don't follow this 100% because I am pretty invested into crypto. However, I'm not afraid to lose the cryptocurrency that I already have. If you have a 401k or a Roth IRA, then you are already invested. Just make sure that when you do invest into those retirement funds, that you are allocating your investments. Some people will put money into a IRA or Roth IRA and put it into a money market fund. That does nothing for you. That's basically a glorified savings account. Make sure that you're actually allocating your money into the appropriate investments so that you can then generate greater returns. Another topic I wanted to talk about is how to open a brokerage account. So a brokerage account is essentially where you will start investing. So I like to use either Robinhood or TD Ameritrade because it's super easy to understand. Feel free to use my links below. But 1, you'll need to open that account. 2, you'll then fund that account with money from your checkings account. You can fund as little as $1 or $100. 3, you'll use the 100 rule to help allocate your investments. And then 4, you'll want to auto reinvest your dividend. And essentially a dividend is a reward for holding a stock or security over time. Now that I've gone through all of that, let's talk a little bit about some of the basic vocabulary that you're gonna run into. So I mentioned this earlier, a bull market is when the stock prices are going up, a lot of people are buying, have a lot of high conviction in what they're investing, and a bull market is essentially the opposite. So that's what we're in right now. Prices are going down, there's a lot of fear, but if you're a long-term investor, bull market and bear market shouldn't really matter because you're kind of in it for the long-term game. Index funds are essentially a basket of funds. So instead of investing all your money into Netflix or Google, you can buy an index fund and you can own a little piece of Netflix, Google, Amazon, anything like that. So it's a group of funds you invest into, so you're not putting all your eggs in one basket. A mutual fund is also an index fund, however, it is actively managed, as in there's someone behind the scenes allocating it to different investments, making sure that it's managed and does well and performs, and you just pay him or her a small percentage of the performances. An exchange traded fund is also an index fund, however, it is not actively managed and it's traded like a stock, like the SPY, which is tracking the S&P 500. When people say to the moon, that means that something is gonna go up. WAGMI means we're all gonna make it. There's a term called ape in, which is essentially YOLOing into all your money into a particular stock or meme. 401k is essentially a retirement fund that's offered to you from your 9-to-5 job. A Roth IRA is a post-tax individual retirement account. So essentially you pay taxes up front and then later on you can then collect the rewards tax-free. And I think that's about it. So hopefully after this, I challenge you to start investing, open up that brokerage account, invest little by little so that generational wealth can be created. Like and follow my page for more tips and tricks on how to start investing and about cryptocurrency.